Hello everyone, welcome to Oliveboard. My name is Dinkar and I welcome you all in this session. I hope everybody's doing great, feeling healthy and fine. As you all know that in Oliveboard we have started with our RBI Grade B concept building series, and this is very important series for all those aspirants who have just now started their preparation for RBI Grade B examination, and they are searching like where I can just build my confidence, where I can build my concepts, so that will provide me with a proper foundation knowledge so that I can build upon it. So that is why in Oliveboard we have especially started this series for all those aspirants who have just started their preparation for RBI Grade B and they don't know where and how to start the preparation. So that is why we have started with this concept building series, especially for all those people who have just now started their preparation. Okay, so this concept building series will be providing you with the concept of ESI, finance and management. So we are pledging for your success. These series will be providing you with the live video batches. We will be helping and slowly we'll be covering the whole syllabus in a streamlined way. At the same time, you will be getting the doubt cleared by the experts, that is by me, and at the same time you will be getting the preparation guidance, that is by me. And as you all know that since you are in Oliveboard, you will be having exam center study. Okay, so today, as in the last class, we have done our ESI session 1, and today we'll be doing our finance session 1. It is a very easy session. Only basic things are there, that is we are going to study, and after that we'll be building some more difficult concept on the finance. Okay, so we'll be studying about the basic of finance first. So under the basic of finance, first of all, we should know what is the goals of financial management. Whenever we talk of the goals of financial management, anywhere, whenever we talk of the goals, we wanted to make sure that what is our return on investment, how much return on investment we are getting, and how is the market value of our per share. Like if somebody has bought the share, or if somebody has invested anything, so what is the return on your investment? That is also called as ROI, return on investment. So this advanced concept will be understanding in future classes. Okay, and then what is the market value per share? The main goals, whenever we talk of the main goals of the financial management, we are normally talking about whether how we can maximize the profit of us, of our shareholder and those who are related to us, how we can maximize our wealth in the long run. Wealth is a long-term concept. Wealth is a long-term concept and profit is a short-term concept. Then how we can economically add the values over there, and how we can minimize the risk. So we have to make sure that how we are going to invest in which all places so that our risk should be minimum and profit should be maximum, and how we can utilize our cost of capital, how we can minimize the cost of capital. Like if you are taking loan from somebody, and if you have taken as a mortgage from somebody, so you have been charged some kind of interest rate. So how we can minimize the cost of capital by properly financial management. Okay, so whenever we talk of the financial management, there are two things that has to be there: investment and financing. Like first of all, where you are going to invest and from where the finance will be coming. These are the two things that need to be made in a business. Investment is what you are spending some kind of capital on an asset where you are yielding some kind of high returns. Okay, so you have to make sure that where you wanted to invest and at which place you wanted to spend so that it can yield you high result. So main task of the investment is that maximizing the value of the firm, and it should be financed properly. Okay, it should not be financed in such a way that your cost of capital becomes more than your profit, and at the time you just go simply into the losses. Okay, and how to pay for them through the process of financing. So all the function of a company need to be paid for one way or the other. Okay, so it is up to the financial department, like how you are going to pay for various department at the same time generating profit. So there are two ways of financing. If anything you are doing, two ways of financing are there. First of all, either you have your own money. Okay, you put that money and you start generating the business, or you are raising the money. Most of the things are working like this. Everybody raise the fund either from shareholders, either from banks, okay, or your friends. Okay, so these are all things are called you are raising the fund from somewhere else. So there are two ways only: either you should utilize your own money, or either you should raise the fund. Okay, so what type of financial decision are required in a fund? If any decision has to be required in a financial decision, what is there? How we are going to do a capital budgeting? You have a capital, where all you wanted to place that money. If you have three type of like you have this much of money, how you are going to spend this money in various places. Okay, so this is called This is called capital budgeting. Then what is your capital structure, from where all your money will be coming, how much is the debt, how much is the equity. Okay, depth and equity I will be telling you in the future, in the coming slides. So you just understand that capital structure means how much you have taken the loan, how much you have put in your own money. All these things are there in the capital structure. And then working capital for day to day functioning, that is the money that is needed for day to day functioning, right? So fundamental principles of money, fundamental principle of finance are what? Only simple question is there: will the decision raise the market value of the firm? Like any decision you are taking, like you are investing somewhere, you are making some product, okay, whatever you are doing for your company, whether that decision will raise the market value of your firm or not. Okay, so there comes the concept of net present value, or we call it as NPV. NPV. Okay, so any business proposal, whenever you are writing any business proposal, you have a concept of NPV. Like yeah, sorry. So whenever we are talking of the net present value, we are looking for like whether we are acquiring any assets or whether we are restructuring our company. So we have to make that kind of financial decision where net present value of our company should be more. That means net present value of whatever the future cash benefit we are going to get should be greater than initial cash flow. Okay, so we are discounting the cash benefit that we are going to get in the future with the today's value, and then we are comparing with how much money that is flowing from my side. If that present value comes out to be positive, then the financial decision is good, otherwise it is not good. So there are four type of financial system that are going on, four type of places where all the finances keeps on going on. First of all is financial institutions are there. That is the first one. Then second one is the financial markets are there. Then third one is financial instruments are there. And fourth one is financial service. Okay, financial system is divided into four parts. Okay, financial institutions are like your banking services are there, non-banking services are there, developmental banks are there, regulatory bodies are there. Okay, then what type of financial markets are there? One is organized, one is unorganized. Then we have a primary where we release IPOs. Okay, secondary market where we trade the already present securities. Then we have a money market which deals with less than 365 days of the period, and capital market is dealing with the more than 365 days of the timing. And then financial instruments can be very thing like your money market. In the money market instruments are there, capital market instruments are there. They can be classified under the short term, medium term, long terms. Okay, and what type of financial service are provided? Banking services are there, merchant banking are there, brokerage firms are there, underwriting, consulting, credit rating agencies are there, discount houses are there. All these things are there. So all these things, whenever we talk of all these things together they accounts for all the financial market, all the financial services, everything related to our country. Okay, now if we go into a more broader view, the financial institution are banking and non-banking. Okay, under the banking we have commercial banks and we have cooperative banks. Commercial bank can be private, regional rural banks, foreign banks, public and private sectors are there. And under non-banking institutions we have NBFCs, non-banking financial companies. We have already known that higher houses, investment houses, loan houses are there. Okay, then financial market we have discussed, it is regarding money market and capital market. Under money market we have a call money market, treasury bills, commercial bills, and commercial papers are there. Then under the capital market we are looking for the primary and secondary markets. Financial instruments are many: securities, secondary securities, equity, dividends, debits, then innovative instruments are there, and financial services. Here we have spread it out. Okay, now based on the nature of claim, we have a financial market as debt or equity. Okay, in the debt market we are taking loan and equity, we are asking the shareholder to provide with the money. Then under the maturity of the claim, we have money market, we have capital market. Capital market, we have two types: primary market and secondary market. Timing of the delivery will be cash market and future market will be there. And organized structure like exchange trade, like we have Nasdaq is there, we have our BSE is there, we have NSE is there, right? BSE, we have NSE, okay, and some are the unorganized that are over the counter. No, this is also a organized market only. Now, some of the important definition that I wanted to discuss over here is that because many definitions are there which normally people don't know, and whenever they come, so they normally get confused regarding what is this, and we are not getting the meaning of that. So that is why I have taken few definitions that I wanted to teach you over here. First of all, whenever you are discussing about the account regarding the financial market, you will be coming regarding two words, that is account payable and account receivable. Okay, account payable is that something that you have to pay and that has not yet been paid. That means all the outstanding amount owed to a vendor, you have to pay to somebody. Okay, then account receivable is something that you are going to get, receivables. Okay, so here somebody has taken something from the credit and you are going to get the money out of it. Okay, so account payable and account receivables are these two things. Then comes the another definition that is called amortization. Okay, so it is called as an accounting technique. Amortization is an accounting technique where we are trying to lower the book value. Okay, earlier we have some NPA of 2 lakh crore. Okay, slowly in the next year we have said we have a NPA of 1.5 lakh crore. Okay, so here we are periodically lowering the book value of loan or intangible assets over a set period. Okay, if we are relating this to a loan, it is like we are spreading out a loan payment over a time. Okay, and whenever we are talking into a term of assets, it is like we are depreciating the value of that loan amount. Okay, earlier when we have given some loan, that asset value is 2 lakh crore, but now after 2 years the value of that asset has gone down. Okay, 1.5 lakh crore. So that's like we are giving us some kind of depreciation on that amount. Okay, now annuity is something where we are giving us some lump sum payment, and after a certain period of time we are getting a regular payment from there. Okay, in the future. Okay, that is an annuity. We have given some lump sum payment. Okay, we have given this is a lump sum payment, and after 5 years I will be start getting every year some monthly income on that. Okay, then what is the concept of arbitrage and arbitraging? Arbitrage and arbitrating is a type of people who buy the securities from market 1 and they sell into the market 2, and they utilize the price difference. Like if we say some security, like if some share if the person is buying this market A is there, one share is there at rupees 16. Okay, in market B the same share is selling at rupees 80. So I buy for rupees 60 from here and I sell that share at the market number B at rupees 80. So I am earning a rupees 20 profit over here. So this is called arbitraging, buying from one place and you are selling at some other place. Okay, so it is like taking advantage of a prices difference. Now bonds are very important. These are the fixed income instrument. Okay, in the fixed instrument we have a bond paper. Here coupon rate will be written. Coupon rate is called interest rate. Okay, if that is of 10 years. Okay, they are said that okay, you take this 1000 rupees bond, and after 10 years I will be giving you this 1000 rupees, and every year you will be getting 10% interest on that. So 10% is what? Rupees 100 you will get for 10 years. And after 10 years your 1000 rupees will be also returned back to you. So that is like a fixed income instrument that you will be getting from there. Okay, that is bond. Then bond rating. So sometimes many companies, very institution releases various type of bonds. Okay, so there is a rating that has been given to the bond. So there is a triple A rating bond are there. That means if you buy the bond of any institution which has a rating of triple A, that means is that bond is highly secure, and the person who has given you this bond is going to oblige by the and you are going to get your money back in the future date. Okay, so this is like a rating from the top to a lowest. If you are taking any company's bond whose rating is D, that means there is a high chance of defaulting on that bond. Maybe you have given your 1000 rupees to that company, but there is a chance that your 1000 rupees may also lost. Okay, so this is like a rating that has been given to the bond. Now circuit breaker is normally related to the share market. Circuit breaker means what? Whenever there is a sudden hike and down in the share market that is going on, so there is a temporary halt that has been done to all the trading in the exchange rate. Okay, temporary halt of all trading on the exchange will be done in order to prevent a sudden up and sudden down of any kind of market. Then comes the credit rating. Credit rating means what is the credit worthiness of a borrower. If I go and buy, if I wanted to take a loan from somewhere and I said I wanted a loan, so the person will check my credit rating. Okay, credit rating is also called, they will check your CIBIL score also, whether if your CIBIL score is good, they will provide you a loans, otherwise they will try to reduce the loan amount, or they will may refuse the loan. So that is the credit rating that you are going to get. Now current asset, what is the meaning of current asset? These important definition I am telling you just because so that you understand that, because in the future these words will be utilized in the future lectures. Okay, so current assets are all the asset that a organization or a company that belong, which can be sold or used within over a period of next year. Like that can be easily get converted into cash. Okay, that can be easily get converted into cash. Like if you have a cash, you have a bank balance, you have investment deposit, you have any kind of inventory which can be converted into a cash. Okay, like your cash equivalent, account receivables are there, stock inventory, market securities, or any kind of things are there. And fixed asset are something that is land, machinery, building, so you cannot convert them immediately into the money, but this you can convert immediately to the money. Then we have current liabilities. Current liabilities are which are the liabilities which you have to pay within a very short period of time of 1 year. Okay, that means you have to pay dividends, you have to use some kind of expenses that you are doing. Okay, you have some note payables are there, you have account payables are there, taxes you have to pay. Okay, and unearned revenues are there. So all these things you have to give within a period of 1 year. So that is why these are called your current liabilities. Okay, so current asset and current liabilities have this much difference. Now current yield. What is the current yield? Current yield is normally utilized to check the prices of the bond. Okay, current yield is investment annual income divided by the current price. Okay, investment annual income, interest or dividend divided by current price of security. Okay, interest or dividend, we can put over here interest or dividend. Okay, so it measure the current price of the bond. Okay, whether what is the actual value of the bond that is there. Like you have bought some bond from somebody, but what is the value of that bond during that market condition, whether the bond is of good quality, whether the bond is of bad quality, whether you are going to get proper return on the bonds or not. Okay, so current yield represent the return an investor would expect to earn if you hold that bond for a year. That is the current yield. Okay, now debentures, we have heard of the word debentures, right? Debentures is also a kind of debt instrument. That means somebody has given you a loan, but it is not backed by any collateral. That means you have not given any collateral for that. You have bought a bond, you have given a bond, but you have not taken any collateral from them, and it has usually a greater term greater than 10 years. So this is only given to the credit worthiness, based on the credit worthiness, because you are not taking any collateral. You are not taking any collateral or anything, so only the credit worthy person, credit worthy institution should only get. Okay, but so it is based on the reputation of the issuer. Okay, so corporations and governments, they normally issue the debentures to raise the capital or fund, because government and some of the big organization have a good credit worthiness and reputation. Okay, and sometimes these debentures can be also converted into equity shares, sometimes, not always. Okay, then comes the concept of dividend and equity. What is the meaning of dividend? Dividend is like whenever the company has earned something profit and company wanted to provide that profit toward the shareholder. Okay, per share they provide some kind of earning per share. Okay, so you are providing this to a public listed company like a reward to an investor for trusting them. Okay, so dividend payout is always announced by the company during their annual general meeting, and then based on the prices of the stock they give certain percentage of that. Okay, now, what is the meaning of equity? Equity represents the value that would be returned to a company shareholder if the asset were liquidated. That means equity means like if some share is going at 100 rupees. So if somebody is having the share of that company and somebody sell that share, so the company has to pay this rupees 100 to that person. Okay. So equity means you are having a shareholder. You are the shareholder of that company, and you will be identified in the company's balance sheet. Okay, so equity means you are a shareholder and you are a part of that company. The amount of share that you are having is based on that your shareholding on that company. Okay, then comes the concept of hedge fund. What is the meaning of hedge fund? Hedge fund are the fund that are very complex, and these are the fund that is pooled for various strategies. They wanted to utilize this for the uh, hedging purposes. Hedging means like they wanted to keep their money safe. Okay, so normally this hedge fund is utilized by the high net worth individual, HNIs. Okay, or any families are there, or any pension fund is there, any insurance company is there, as the bank is there. So they are only utilizing this hedging fund. They are putting their money in the hedge fund. They wanted to generate the profit, at the same time they wanted to save their money. Okay, so these hedge fund, they are not required to register with the security market, and they are not also subject to any kind of reporting requirement or any kind of disclosure of the net asset value. Then the comes, so here hedge and hedging fund. Hedge fund and hedging is two different things. Hedging is that we wanted to manage the risk. Hedging means we wanted to manage the risk and we wanted to offset our losses. Okay, so people do hedging in order to offset their risk. So whenever people do hedging, they reduce their risk. At the same time, their potential profit also get limited. That means they set the value, like even whatever the values goes up and down. Like if I say that, okay, even the prices of rice, even if the prices of rice goes to 200, but I will sell you at 180 only, because I have a fear that maybe the prices should go below 180. I have a fear. So I have fixed the value of 180. But if the prices of rices goes 250 also, the person will get only at 180 rupees. Okay. So here the profit is limited. But here you have prevented your losses also. Okay. So this is called the hedging technique. Now, high frequency trading, some people do very high frequency every time in the share market. This high complex algorithm is there. At the single second, thousands of transactions are happening in the share market everywhere. So that is called high frequency trading. Then comes IPO. Whenever any company wanted to list that in the share market, they releases IPO and they allot the shares to the general public, offering the shares through a primary market. So whenever any IPO comes, it comes in the primary market first, and after the share get listed, it will be bought and sold in the secondary market also. Okay, then comes the concept of insider trading. Insider trading means if you are working in any company, okay, and if you know some secret information regarding that company or any secret announcement that company has to make. So if you have released this information to your friends or anybody or into the market in order to gain some kind of potential profit, so that is called insider trading. Okay, that is called insider trading. So there is a person that is called, I think Rajat Gupta was there. He was in UK. Okay, he has done insider trading in the banking regarding the interest rate, and because of that he got arrested for that purpose. So insider trading is a criminal offense, and sometimes people utilize this insider trading in order to gain some kind of a profit or some kind of materialistic gain they wanted to take. Okay, so insider trading is a illegal offense. Then comes the concept of line of credit. What is the meaning of line of credit? Line of credit is something which is available to you every time. If some bank said, okay, if ICICI bank said, I will give you a line credit of 5 million. So you can go to the bank and take the 5 million as a line of credit anytime, anytime. Okay. And after that, you have to give it to the bank, and again, your line of credit will be there. Okay. So within this 5 million only, you have to take, like you may take 2 million. Okay. Still 3 million is there for you to take. Okay. You cannot take more than 5 million. Okay. Then you provide that 2 million to the bank. Then again, your 5 million credit limit again come. Okay. So this is called line of credit. Then comes market capitalization. Market capitalization is like how much is the company's worth? How much is the company worth in the stock market? By adding all the shares, all the values of the shares. Okay, so this is like how you are calculating the market capitalization. Whenever we said Reliance is a $500 billion company, Saudi Aramco is a $1 trillion company. Okay, whenever we say that, we are just finding out what is the market capitalization. What we are finding out what is the share and what is the share value of that company. Okay, so current market value of that company. Okay, then comes merger and acquisition. These are the two confusing words whenever we are talking about merger and acquisition. Whenever we are doing acquisition, okay, one company purchases it outright. Okay, the company purchases the other company, but the name is not changed, does not change the legal name of that company, but now it is owned by the parent company. Okay, the name is not being changed. Okay, that is called acquisition. And whenever any merger is going on, the two firms are doing merger, so there will be a totally new legal entity form and with a new corporate name. There will be a new one corporate name, either the first company name or the second company name, they can do it. Okay, merger means there is a total merger of the two things and there will be a new one corporate name. In the acquisition, one big company buy a smaller company and they retain all the legal name and structure of that smaller company. Okay, then comes mortgage. What is the meaning of mortgage? Mortgage is also a debt instrument where we are utilizing collateral in order to secure a loan. Okay, whether we are putting like put our house on mortgage. Okay, you are giving a house as a collateral and you are getting some kind of money that you will be pay back in the future. Okay, so mortgage is normally related to the lines against some kind of property. You have to give some kind of property claims on that property in order to secure some kind of loan. Okay, then comes mutual fund. So mutual fund is also a type of investment vehicle where a group of investment portfolio, like the mutual fund will be a mixture of stocks, bonds, other securities. Okay, so your money will be invested. So like if you say, like you go to a mutual fund company, and there is a mutual fund company, they said that, okay sir, you are giving 1 lakh rupees, out of that 50,000 we will be investing in shares, 25,000 we will be investing in bonds. Okay, another 25,000 will be putting some innovative. So this is like a mutual fund. Okay, your 1 lakh will be invested into the various instruments and that will be managed by the mutual fund company. Okay, so this gives a small and individual investor. Normally mutual fund is for a small and individual investor, so their money will be put into the diversified areas and it will be professionally managed by the person. Then comes Ponzi schemes. Ponzi schemes are fraudulent investment scams. They tell you that we will be providing a huge amount of interest rate. Once you invest here, we will give 20% return, we will give 30% return. Okay, so Ponzi scheme generate return in the starting. They generate in order to secure the investor. In the starting, they give you the money, they will show you the money, they will show you each and everything that something is happening. Yes, people are getting the returns. Okay, after good amount of money comes, so they will follow a pyramid shape, or we call it as a chain system. Okay, one person will connect two people here, then these two people will connect these two people here, this person will connect this two people, this two, then here these two. So the profit will be only getting by this person, rest all people will be getting a pie, only a pie, or even less than a pie. Okay, so And once the company generates good amount of money, they sometimes leave with the money, leaving all the peoples behind. Okay, so these are the Ponzi scheme. Everybody has to be aware that India is having like everywhere some kind of Ponzi schemes are running everywhere. So government has to make sure that these has to be properly regulated, and all the ban and the proper strict action should be taken against these schemes. Okay, now prime rate. Prime rate is like a interest rate that commercial bank charges to their most credit worthy corporate customer. Like whenever you go to any bank, they will charge you, okay sir, I am going 9% interest rate. Okay, if you're taking loan from us, we will be you have to give 9% interest on your loan. Okay, but if any very good credit worthy customer corporate comes to the bank, so for their credit worthy customers, they are giving some kind of prime rates. Prime rates are like that has been especially offered to their credit worthy corporates. Like they will say, okay sir, normally I am charging 9%, for you it is 8%. Okay, that means you have to pay less interest rate. Okay, so this is called prime rate lending. Okay, so these are some of the important definition and the financial system, and later on we will be building our basic concepts on all these lectures. Okay, so guys, we are offering you a course that has been run by the Oliveboard. It is a very important course, that is RBI Grade B 2023 mentorship batch. Here you will be getting a dedicated mentor especially for you, and they will be doing 6 months of rigorous preparation with all of you. You will be getting a customized study plan, and for 6 month rigorous preparation you will be doing, you will just go and check the descriptive box and you will get all the information. And we are running our winter fest. Here you can save 35% off. Just utilize the code winter, and automatically 35% off will be given to the SEBI grade A courses and RBI grade B 2023 courses. So I'll be seeing you in the next week. Please download our RBI SEBI Nabard proprietary app, and all the regulatory body information you will be getting over there. That is an exclusive YouTube channel. So thank you so much guys for joining the session. Please provide your beautiful comments. Thank you so much for joining the session. Great to have you here. Bye bye. Take care, and I'll be seeing you in the next class.